Good morning. I'm Susan Thompson, Director, ESG Solutions at TD Securities. I'm joined today by Richard Manley, CPP Investments Chief Sustainability Officer and Managing Director and Head of Sustainable Investing. Richard, I'm thrilled to be speaking with you today. CPP Investments has for many years been vocal about its belief that organizations able to effectively anticipate and manage sustainability-related risks to their business are more likely to create and maintain long-term value. As an investor, CPP Investments has clear expectations on how companies manage ESG-related risks and opportunities. It also has a long track record of engaging with companies to convey its views. For its part, CPP Investments has announced its commitment to achieve net zero greenhouse gas emissions across all scopes by 2050 for its portfolio and operations. It is also committed to increasing investments in green and transition assets to at least $130 billion by 2030. Recently, TD Securities and Deutsche Bank canvassed top ESG investors globally to understand their priority areas of focus, uncertainty, and concern when discussing asset managers' approaches to ESG integration within the investment lifecycle. In other words, their burning questions. Through our discussion today, we plan to tackle some of these challenging questions posed related to CPP Investments' decarbonization strategy, asset classifications, approaches to portfolio company engagement, divestment, and more. You ready? Let's dive in. So CPP Investments considers an asset to be a transition asset if it has committed to reach net zero with a credible target and plan. How specifically does CPP Investments determine the credibility and net zero commitment and associated transition plan?
Thank you. Starting with the easy one.
Absolutely.
Okay. So when we set our green and transition target, there was a very real appreciation that we could see taxonomies emerging around the economy, but we could also see that definition of green and definition of transition were likely to not be static over time, that evolutions were going to evolve. So the thing that we felt because we were clearly approaching net zero in a different way to other asset management firms, was that we had to ensure that we had an approach to defining green and defining transition that we could walk back from. In a strange way, I think there's an expectation that some people are saying they anticipate to walk forward. I think where we weren't giving a near-term greenhouse gas reduction target, we felt we had to take a very, very robust stance on both the definition of green and the definition of transition. So where we initiated was that the company's plan would have to be corroborated by an independent body. In the first instance, for public securities, that is SBTI. For private assets, we do have situations that we are currently not effectively marking them in the ledger as transition assets, even though we have comprehensively underwritten the ability to take that asset down to net zero over time by virtue of the fact they haven't yet sought SBTI approval of the strategy or acknowledgement of the strategy and sought the appropriate certification. So the view at the moment is SBTI. I think that what I would go on to say, though, is that SBTI is the tool we have available to us today. I would anticipate that the tools available to us over time transform. SBTI, I think, clearly spells out how a company should prioritize the different decarbonisation levers they pursue. It also spells out the degree of ambition that they should seek to deliver in order to comply with science-based targets. What we'd like to see next, though, would be the ability to corroborate, I suppose, supplement that with insights into whether that transition plan is both technically and economically feasible. Because at the moment we have the very objective appraisal of ambition and also the levers they use. We think over time it would be valuable in how we think about the identification of those assets and the labeling of them on the balance sheet if we can get that extra insight.
Thank you for that. It's all interesting on just to hear those insights on what you rely on a little bit. Along the same lines of classifications, CPP Investments developed an impressive abatement capacity assessment framework to measure the capacity of organizations to remove or abate their greenhouse gas emissions. In 2022, you piloted this framework. How has it been deployed into 2023?
Okay. So absolutely right. We introduced the methodology ahead of COP26. We published the first pilot ahead of COP27, and we will be publishing a subsequent report ahead of COP28, where we outline the results of the next 11 pilots. And also applying it to ourselves. We thought if we were going to advocate for portfolio companies to try our medicine, we should probably try it ourselves, and we learned a lot in doing that. So another 11 readouts, but also I'd say enough feedback now and enough reps to appreciate that if we had drafted the report again today, we would probably want to provide a little bit more advice to the consumer of the methodology, exactly how to approach implementation. So that's what we'll try and capture in the report. Maybe just a quick recap on why we launched this methodology and how it ties to the first question on defining of transition targets. And look, there was an overwhelming momentum in the run-up to COP26 of companies committing to net zero. And you may have seen the piece that we published saying, or a likening to a corporate committing to net zero is like a human committing to run a sub 2-hour marathon. Nobody's ever done it. Well, it's been done in a test environment, but nobody's actually ever done it in a live environment. But if you say you're going to do it, the first question it elicits is, what's your personal best? How quickly can you run a marathon today? And I think what we sought to have was a methodology to identify how much greenhouse gases can a company reduce today or remove today from its portfolio, leveraging precedent regulation we have actually for the oil and gas industry that you must get an objective appraisal of the recoverability of your reserves if you are going to communicate to the market forward guidance on production. So it really does identify the emissions reductions that are technically and economically feasible, a proven abatement capacity. We think they should really be in the business plan. Technically abatable but not quite economic, probable abatement capacity over time. The likely source of uneconomic performance is likely to improve. It'd be helpful to understand that, to see what is likely to be doable between now and 2050. And then uneconomic, it's either technically not possible or so expensive that at the moment it's not obvious that a company would do it. And there we'd like to see companies report what they plan to stop, what they plan to offset, and where they are actively diligencing new solutions that could become economic over time. So we've applied that to the extra companies. All of them were able to identify very tangible potential to decarbonize today. We're working with all of them to get that integrated into short-term targets. But we also importantly learned that developing a decarbonisation plan is just not something that can be done from the executive suite of a company. It requires the whole organisation's engagement. And importantly, the first thing everyone should seek to start with is efficiency. The challenge of efficiency is it's not about what assets you have. It's about how you use them. You've got to do that from the inside. You can't do that from the outside in. But the beauty of doing that first is it's no regrets. The return on efficiency is massive. It allows you to engage your entire employee base to start the journey towards decarbonisation. And importantly, it buys very valuable time to work out of the levers you have that require capital investment. How should you prioritise them and plan them, get the materials in place to make sure they happen, but still deliver Paris alignment. So it's been a great exercise. The methodology is published under something called Creative Commons. So any of the institutions that are watching this are absolutely at liberty to use it themselves. And if anybody's got feedback, we'd love to hear it.
Perfect. Looking forward to hearing more about that. If we can switch gears, I guess just slightly to customer engagement and investments and divestments. I guess CPP Investments' rationale for remaining invested in fossil fuel companies is so that it can enforce expectations and use its governance rights to influence companies failing to adequately address climate risks. What are those expectations? And as a follow-up, how regularly and through what means do you monitor progress and compliance?
Okay. So our climate engagement, or our expectations of boards with respect to climate were published 3 years ago. The last 3 cycles of engagement have focused very, very clearly on the highest emitting assets within the portfolio and those that we have the highest economic exposure to as well. So it's been a very concentrated approach. And the energy sector has a dilemma. It has things that it can control, and it has issues it can't control. And the issues it can't control are why the IEA is still of the view that while we will have peak hydrocarbon consumption this decade, we will still see hydrocarbons in the economy for a long, long time to come. Somebody asked me the other day, I was discussing with them the likelihood that at COP28, the oil and gas sector will come out with some very bold climate ambitions. We're expecting them to come out with very robust targets on the reduction of fugitive methane release, but also commitment to net zero, scope 1 and 2 by 2040 for all of their own value chain operations. And this could be the international oil companies and the large national oil companies in large parts of the world. Now, why would that be significant? Would it be significant because at the moment, 15% of global emissions are coming from the production of hydrocarbons, not just their combustion. So the ability for the industry to attack that 15%, the 15% it controls, is fundamental to reducing the emissions intensity of molecules that all of the modelers, certainly we ourselves, expect are likely to be burned for some time to come. I'm reluctant to calling them green molecules, but certainly they would be lower carbon hydrocarbons if you drive down fugitive methane to zero and they're delivered with zero scope 1 and 2 from production to processing to transmission to delivery. It really means that for the airline, the bit that the airline can't currently deal with, the combustion, the upstream scope 3 emissions of that value chain are addressed by the producer and the midstream companies. For the gas utility that still has to continue to burn gas in power generation, again, the upstream emissions go to zero, meaning the residual is only the combustion. So knowing that this industry is going to be producing these molecules, I suppose our view and our engagement approach is how do we ensure that where molecules are being burnt, they are the lowest emissions molecules that can be possibly delivered to the market. So our engagement is around following the logic. Is there appropriate board oversight of this? Is there appropriate challenge? Has the executive been required to identify and quantify climate risks and opportunities in the portfolio? Are those insights translating into strategy? So are they resulting in tangible short-term emissions reductions targets and an attempt to appraise what they do beyond the currently proven economic molecules to decarbonize over time? There have been some votes against. There have been some very considerable wins. We've had multiple companies in response to our engagement commit to delivering the building blocks of that ambition. I think we appreciate that we shouldn't expect everybody to go from disengaged to world-class in one cycle, but our escalation policy is that if you make progress, we will effectively maintain support for directors. If progress stalls, or you are unresponsive, we will escalate each year. So from the chair of the committee responsible for oversight of climate to the entire committee responsible for oversight of climate, ultimately to the entire board.
That's your work cut out for you, I think, in some respects. I guess along those same lines, can you share an example of CPP Investments divesting from a portfolio company to the extent that you can, due to the company not meeting climate or other ESG-related expectations?
I can, and
Just in broad strokes.
broad strokes. I'm not going to mention any names for obvious reasons, but
Yeah.
I'll give you a bit of a historic context where we are today and where we see most instances of either divesting or not investing because of ESG issues. So most of the listeners will be aware of the balancing portfolio. Historically, the balancing portfolio was physical index replication. So owning the shares of all the index constituents, where clearly, as we identified companies that were in the index, where there were ESG issues that we believed were sufficiently significant to translate into impairment of value, we were able to effectively remove those individual equities from our replication of the index. Today, a growing share of the balancing portfolio is implemented synthetically. Many of the people watching will be aware of the fact that the cost differential from moving from benchmark synthetic products to customized synthetic products is quite prohibitive. The collateral requirements are larger, the bid-ask spreads are larger, the available liquidity is a lot smaller. But where we still have physical implementation of the balancing portfolio. As recently as about 3 weeks ago, there was one company whose since listing, the business model had changed quite a lot. The evolution in the business model had resulted in a growing ESG risk that resulted in us concluding that it had now attained a level of risk that we felt was no longer being compensated for in the portfolio. So that was a recent example of a divestment. But I'd say actually now, given how much of the portfolio is actively managed, both in public and private markets, the steady state regular intervention and integration of ESG is resulting in multiple cases a year where we put pens down on a new investment because we, first of all, in screening, have identified the existence of an ESG risk. As we move through the due diligence, what we're seeking to understand is that risk is actually being actively managed by the company to reduce it. And it can be many things, that actually there's no board oversight of the issue, that there's no policies in place to reduce the risk associated with the issue. There's a complete disconnect in terms of our expectation, the management's beliefs around the issue, or we identify that the specific controls and reporting are unconducive. Now, in private markets, where you identify one of those challenges and you can see through the negotiating dynamic, it's going to be very difficult to get it addressed. A relatively recent situation, we concluded that the disconnect between us and the prospective management team around the issue was probably going to be too large to gulf. So we didn't move forward with that transaction. In public equities, where our governance rights are a little less than we have in the private market, it's a more regular occurrence that we will decide not to move forward with an investment because we've identified a material ESG issue in the business that is just not managed.
Thank you for sharing all that. That was definitely one of the harder questions, and for sure one of the burning questions that came up from the investors that we canvassed. So taking it, I guess, just definitely taking Canadian lens on it, the summer's unprecedented wildfires in Canada has continued to have record-breaking implications upon Canadian industries and communities. So how can CPP investments help address the immediate concerns associated with these disasters?
So this is another biggie. I know that you promised me they'd get easier as we went through, and this is not an easy one. In part because we attained carbon neutrality at the end of fiscal 23, so March of this year. And obviously, to do that, we had to understand that was carbon neutrality for scope 1, 2, and effectively scope 3 business travel. To do that, we had to obviously understand what all of those emissions were. We had to set targets for their reduction, and then we had to offset the residual. And for all those institutions that haven't yet gone about procuring offset, I'll tell you, it's not an easy process. It's still a nascent market, but given our motivation to do this was to be able to engage credibly with portfolio companies that we understand what this involves. We understand the procurement process. We understand the need and value in identifying quality offsets, and then the challenge in attaining them. All of the offsets that we bought were actually in Canada and forestry assets. And the source of their additionality was protecting and growing the carbon capture capabilities of Canadian forestry systems through reforestation, afforestation, and active management. And importantly, within the active management was their protection from fire. I will confess to you that every time I see a new fire started, I call the member of my team that's responsible for our offsets to seek confirmation that our offsets are not vanishing. But what I'll say also within there is really important, that nature-based solutions that are actually seeking to protect environmental systems like forestry, there is very clearly the opportunity for human intervention in forestry assets to protect them. And I think in one case, look, it's certainly heightened for us the risk of nature-based solutions as an asset class, but it's also, I think, simultaneously given us conviction that there really is value if we can create a sustainable methodology for compensating for the protection and preservation of these systems for market participants and companies in the real economy to be doing this. I think the other challenge, though, here is not just how we think about the forests themselves, but how we actually think about physical risk in portfolio companies, and where not only the physical risk to their plant and operations, clearly we have seen some manufacturing capacity lost in fires over the course of the summer. But I think there's also an opportunity here to think about where business models have a dependency on ecosystems. And this year, there were two important new additions to our proxy voting principles. One of them was that we believed, as it was very clear we were about to see a massive acceleration in the deployment of artificial intelligence, that we wanted to make very clear to boards that if your company deploys this, you are responsible for its responsible deployment. And I'll put it out there, I think it is more likely that we see a major value impairment event for a company in the next 5 years through the irresponsible deployment of artificial intelligence than it is a transition risk or a physical risk, tied to climate. But then coming on to nature, we also said, look, we believe it's the responsibility of the board, as we did originally sustainability, then climate, now nature, to ensure that it has compelled the executive to understand whether their business or their supply chain has a dependency on natural systems. Once it's identified the dependency, to then determine whether it's sustainable or otherwise, and if they conclude it to be unsustainable, to develop remediation plans. Because knowing that you have a dependency on a natural system that is likely not to thrive or survive long term, but doing nothing about it is not, again, obviously acting in the best long-term interest of the company. That did elicit some outreach. What do you want us to do here? And I think we've already now started to see with both the UK government's proposed transition plan task force, there's an expectation there of companies as they develop transition plans, not just thinking about the decarbonisation of the business, the physical risk of the business, the just elements of the transition, but also dependency on nature, and also the recent launch of the TNFD. We're a member of the TPT. We've took an observer seat on the TNFD, in part because we already had a seat on the TCFD, and I chair the ISSB Investor Advisory Group. So we're pretty invested and saying pretty committed to the development of market infrastructure, and certainly felt it appropriate to keep that lens on the development of nature-based reporting.
Right, so I think this brings us to our last question.
Okay.
One that I think our Canadian viewers will be interested in. How has CPP Investments determined that financing climate change mitigation is in the best financial interest of Canadian pension holders?
Okay. So, great question to end on. I hear so many normative arguments as to why financial institutions should do this. It's the right thing to do. We must do it. And look, there are people that sit on both sides of that debate. But just putting that debate to one side, and certainly my own position is, I think we have an obligation to work out how to protect long-term value by confronting climate change. But there's another very real consideration now for the real economy and for financial market participants. And that is that pretty much every government in the world has committed that it will pursue the comprehensive decarbonisation of its economy by the middle of this century. Now, the way I would frame that is the most clear, forward-looking policy guidance that a fiduciary could be given, that while the government may not have yet identified every single intervention it will pursue, you should be anticipating these interventions are coming. And if you are seeking within a corporate setting to demonstrate as a director that you are acting in the best interest of the company, the way that you would demonstrate that is ensure that the executive were determining how it could comprehensively decarbonize the business by the middle of the century to ensure it was a going concern. And clearly that's what drove our voting policy, and that's what's driving our engagement. But that, I think, can then be extrapolated to us. Now, the one thing that I think has occasionally been lost on observers of the financial sector is that we don't control the companies. The financial market is a look through to the real economy. that you actually can't decarbonize a portfolio through divestment on a sustainable basis. An individual institution at any point can lower its carbon intensity, but that doesn't actually reduce transition risk in the system, doesn't really reduce transition risk in your portfolio, it just moves it to different places. So, our focus then becomes, okay, what can we do to support decarbonisation in the real economy? Knowing that areas of the economy that don't decarbonise are likely to see a contraction in their value until they pivot and respond, and areas of the economy that are able to provide solutions to decarbonising the economy are likely to see a tailwind to the top line. Notice I say a tailwind to the top line, not massive value creation. And that I think is something that is also occasionally lost on people, that growth is an important tailwind to value creation. It doesn't guarantee outperformance. And certainly is one of the things we've started to see is some taxonomies have been introduced in certain parts of the world. The expected returns on parts of our renewable energy portfolio at different points have been marked at as low as 4%. And that may prompt the question, well, if the market's pricing 4% at expected return, should you be selling those and recycling them into other parts of the economy where the expected returns are higher? And the answer there is clearly yes. But on the specific question of financing mitigation, we are now seeing multiple examples of more carbon intense areas of the economy derating, in part because people are moving money out of them, but areas of the economy derating where there are very tangible opportunities to decarbonize them. And the idea that as a result of some of the market microstructure shifts that are taking place, the idea that we can buy assets at really bombed out multiples, underwrite an investment thesis that is we will invest the money in decarbonizing it to over time make it a green asset and be able to exit it on the multiples that green assets trade on, is a very, very real opportunity, not only for us to deliver investment returns for our beneficiaries, but also a way for us to actively contribute to the decarbonisation of the real economy. So that's the rationale in terms of how it manifests itself. But what don't we control? We don't control changes in consumer behaviour. We don't control the technology, but we can clearly finance more innovation taking place in the real economy. We don't control the development of market infrastructure, so reporting standards and carbon markets, but again, we certainly can contribute to their development and we're actively doing so. We don't control corporate delivery, but we can certainly engage with our portfolio companies to compel them to do a better job. And lastly, we don't control regulation, but one thing we will obviously, of course, do is share with regulators where we encounter certain interventions that are undermining the ability for the economy to decarbonize. So what does that mean? It means we are going to commit to continuing to invest in new technology solutions. We'll scale those technologies as they become economic. And importantly, we will make transition financing available where we have conviction in the feasibility of the desired outcome, that it greens, and secondarily, that we believe we've been compensated for the risks we're assuming so in doing that.
Really look forward to seeing and hearing what you have planned over the next few years. Anyway, thank you very much for joining us today. Thank you to our global investors that we canvassed and submitted the questions. And once again, Richard, thank you very much for taking time to speak with me today.
Thank you for moderating this, and thank you to everybody for their interest in our approach to ESG integration.
Thank you.
Thank you.